All right, so today what we're going to do is we're now transitioning from the income statement to the cash flow statement. And I want to illustrate, it might be a little bit simpler for those that have core knowledge of finance, but the purpose of these courses is that anyone can start building a model from scratch. So I want to do a quick recap of the very first class financial statements, show how it ties into the cash flow statement from a high level, because the purpose is to be able to understand the difference from a conceptual standpoint between the income statement and the cash flow statement, to show you why I think about it from a modeling perspective a little bit different. So as you may or may not recall, the income statement is a measure of financial performance over a period of time. I'm going to kind of rush through this, where we're mainly thinking about revenue minus any expenses that are tax deductible would create your net income, right? And the original purpose of the income statement was, well, okay, you're a business making some money, you got to pay taxes, but the costs associated with producing that revenue can be used to reduce those taxes. That's where it all started. And then net income became a measure of profit and value. Now, what is important is there's a couple of metrics in the income statement that we really need for purposes of valuation, which is part of the main goal of this course, to value Amazon. And one is EBITDA, EBIT, EBT, all the E's. And so EBITDA is at its core earnings before interest, taxes, depreciation, and amortization. And just popping up the model real quick, we had laid that out. That is a proxy for cash flow. We'll talk about that when we continue with our model. And that is often thrown around and used in metrics of valuation that we'll see when we get to the end of the course and determine what Amazon stock price should be. Now, once you get EBITDA, you can slowly subtract away the components of EBITDA to get to E, earnings or net income. So EBITDA is earnings before interest, taxes, depreciation, amortization. You subtract depreciation and amortization from that, and you have EBIT, or earnings before interest, taxes. You subtract interest, income, and expense from that, and you have earnings before taxes, or EBT. You subtract taxes from that, and you have net income. And so when thinking about that, it's, I think, easier to understand the core structure of an income statement. And I like to think about the structure of an income statement in 9 different segments. Revenue, 1. Cost of goods sold, 2. General other expenses, 3. Depreciation and amortization, 4. Other income, 5. Interest expense, 6. Income tax expense, 7. Then we have non-recurring events and other distributions. Other distributions meaning non-controlling interests or dividends, 9. And the reason why it's important to identify those 9 segments is because when looking at an income statement of a company, of any company, the idea is when you're looking at each and every line item in an income statement, they should be presented into one of those 9 categories. And so the reason why I'm explaining things this way is because the biggest difference we're going to see between the income statement and the cash flow statement is the income statement, and then from an analyst's standpoint, is often rearranged to be better presented for analysis. Whereas what we're going to see is the cash flow statement is basically laid out kind of verbatim. And the reason for that is because one of the key metrics that we just discussed, EBIT and EBITDA, is not a GAAP requirement. It's not a generally accepted accounting principle requirement. So when laying out an income statement, we want to make sure we're laying it out with the mindset of an investor, and we want to be able to make sure a lot of these key metrics come to light. So when we first opened up, let me get over to my Amazon folder and pull up. When we first opened up the Amazon annual report, actually, I have it open. Here we go. We first went to the Amazon annual report, which you'll you'll see in almost every single company. I've rarely seen it laid out exactly the way we want it to be. But you have sales, which we've obviously laid into the revenue bucket. We've had cost of sales, which just by the wording there, you can easily imply that's cost of goods sold. And you have these other expenses. Now you can see right off the bat that they've just laid every single expense in an operating expense section. We want this separated out into a cost of goods sold section and an other expense section, which we had done in our model, right? We have revenue, then we had cost of goods sold, then we were able to build gross profit, and then all the other expenses were in operating expenses, and we projected it out accordingly. That allowed us to pull out EBITDA. Then we had to go, if you recall, and you can go back to the prior classes, we had to go back and figure out, well, where is depreciation? They don't show depreciation here, but we know that they depreciate assets because they explain it in their annual report. So we had to find out where it was, extract it, and list it separately, because it's important for us to have depreciation to be able to create EBITDA versus EBIT, because the difference between EBITDA and EBIT is depreciation. So quick recap here. Then we have other income and interest expense, interest income, which are, again, several of the 9 categories we discussed. That gave us income before taxes. Then we have taxes, etc. So we were able to lay things out. We didn't change any numbers. We just represented in the light that allowed us to have now a full income statement with our quote unquote clean net income for analysis, EBIT and EBITDA for analysis that we could pull into our discounted cash flow model or whatever models. And we will do a discounted cash flow model at the end of this course. So to illustrate from a conceptual standpoint the difference between an income statement and a cash flow statement, here is an example we spoke about. We spoke about a small, in the very first course, wholesale distribution business, right? This is, let's imagine a truck. It's a shipping company, let's say, right? It is a truck going around delivering packages. And let's say that the company books $10,000 in revenues in the first quarter. A small little company, one guy, one truck. There are various expenses that were utilized in the company's operations to produce those revenues. Let's say $1,500 for salary, $2,500 for cost of goods sold. Let's say, maybe costs of, packaging, things like that. $1,000 for fuel, which is also another operating expense for the truck. Vehicle depreciation, amortization, and then trickling down to taxes. Okay, so if you lay things out in a proper income statement, there is $2,100 in net income. Okay, so we talked about this before. Now, cash flow. So let's say a company went to its bank account. It's got one truck in its fleet. He's produced $2,100 in net income. Let's say, just to illustrate the example, there are some repairs, a truck breaks down, engine repairs, needs to make $1,000 in repairs. And he says, okay, I'll go to my bank account. I got $2,100. Well, illustrating the concept of cash flow, he doesn't have $2,100 in his bank account. He only has $100 in his bank account. Why? Well, again, obvious for a lot of people, but there is a difference between income and cash. Why? There's a lot of things that can happen in terms of generating revenue and in terms of recording expenses that may or may not have actually been translated into cash yet. So for example, you can bill a customer $1,000. You can send that customer a bill in the mail. Maybe you didn't get paid for that yet. You'll still record it as revenue because you've made the sale, but you didn't record the cash yet. Or conversely, you can get a bill. You get a fuel bill, let's say, although with trucking and gas, you probably went to a gas station. But let's just say you got a bill for, I don't know, you ordered a bunch of cardboard boxes and you got a bill for it in the mail and you didn't pay it yet. Let's say you didn't use a credit card. So you have an expense that is listed as an expense for operating purposes, but it didn't hit your cash account yet. Now, this is the core fundamental reason for why we have a cash flow statement, right? You want to understand, okay, well, I've generated 2,100 in income, but how much of that has actually moved my cash account? So to further that illustration, we're going to assume or suggest, we're going to say that this person did not consider that of his 10,000 in revenue that he recorded, 35% of his customers paid on credit. So 35% of his customers got sent a bill, didn't pay yet. 65% paid right away. So he needs to adjust for that. Okay. So really what happens is when thinking about, all right, well, when I take my income statement, look at this as an income statement and say, well, how do I convert this into a better representation of how much cash I actually have? You have to pull out anything that's not cash. So if 35% of his customers did not yet pay, you have to take that away. So 35% of 10,000 is 3,500. So you got to subtract $3,500. And now let's also argue that, well, let me just, it's not an argument. This is a constant truth. We will see when we talk about depreciation. A depreciation expense is not cash. You never write a check for depreciation to anybody. It is a, I don't want to say conceptual, but it is a method for accounting to reduce your taxes. We'll talk about that. So even though that depreciation expense reduces your net income, you will add it back. It is a non-cash expense. So like you will remove revenue that you did not actually get yet, you will add back an expense that reduced your net income that you actually did not pay. So when you look at this income statement and you go down line by line and say, how much of this has been cash? We will say, okay, revenue. Some of those customers did not pay me yet. Subtract out 3,500. Cost of goods sold. Let's say I paid cost of goods sold. I don't touch it. Let's say I paid my general and administrative. I paid my fuel. So these expenses accurately reflect my cash. I will not touch it. Depreciation. That depreciation expense reduced my net income, but I never actually paid it. So when thinking about cash, I'm going to add it back. Interest. There's no interest in this example. Taxes, I paid. So when thinking about converting net income to cash, I need to add back my 3,500. I need to subtract out my 1,500. And when you do that, here you look at this, this is the same income statement, 2,100, subtracting out 3,500, adding back 1,500, that's the $100. Very simple way to explain a concept that often confuses a lot of people. This is why you think about at its core, cash flow or cash flow from operations, for those that want to delineate it further, is really your net income subtracting out your non-cash items, or subtracting or adding out, adjusting for your non-cash items. You add back your receivables, you subtract out your payables, and that's why. So when thinking about this and inferring it into what an actual cash flow statement is, an actual cash flow statement is three major segments. It is one, your cash from operating activities, which is basically just what we illustrated. It's taking your operating activities or your operating income statement and extrapolating which of that is cash. And you do that by adding depreciation and making adjustments to your payables and receivables. And for those that know already, we will learn that cash from operations is net income plus depreciation and amortization plus other things, plus or minus changes in working capital. I've just made a very simple explanation of how that is, but we'll dig into that deeper. That's one segment, your cash from operations. Further, cash can be received or drawn or pulled from two other categories. Cash from investing activities, investments that are made. Most commonly, capital expenditures, right? This is money set aside for the future maintenance or improvement of the property and equipment that you have. CapEx, that's money spent, separate from operations. It can also include other investing activities like investing in stocks, buying and selling other businesses. That's cash from investing activities. Then you have cash from financing activities, raising debt, buying back debt, raising equity, buying back equity, paying out your dividends. Those are all examples of cash from financing activities. So the cash flow is basically broken out into these three major segments. Okay. Now, when going back to this net income statement example, there's a nice way of laying out and digging into a little deeper what cash flow from operations is. And I love looking at it this way because a lot of people memorize what cash flow from operations is. Net income plus depreciation plus other, but this explains exactly where it comes from. And it comes from thinking about every single line item, thinking about all those 9 categories I talked about, every single line item in your income statement, and thinking about the possibility of considering whether each line item may or may not be cash. So for example, first line item, revenue. If there is a portion of revenue that is not cash, from a cash flow perspective, we consider that accounts receivable, right? Some people may or may not know this, right? If you have a customer that you've billed that has not paid you yet, it goes into an accounts receivable account. An expense that has been billed or you received a bill for that you did not yet pay, once you receive that bill, you record it in an accounts payable account, right? Accounts payable, or you can also record that in an accrued expense account. There is a difference between accounts payable and accrued expenses. We talk about that in the more advanced courses, but generally and more specifically, accounts payable, the difference between accounting for accounts payable and accrued expenses is very, very similar. The mechanics are very similar. From a modeling standpoint, I don't know if it makes too much of a difference, but accounts payable is usually expense items that are collateralized, that can be collateralized, go into accounts payable. So for example, that's why oftentimes you will see cost of goods sold related to accounts payable, because oftentimes, I don't want to say usually, and I don't know how it's going to work for Amazon. We need to dig further, but cost of goods sold is, if it's a product that you're selling, cost of goods sold is inventory, right? Inventory sold, and inventory can be collateralized. It's an object, it's tangible. Whereas an accrued expense, fuel, salaries, usually cannot be collateralized. So that's a lot of people don't follow this difference, and we're getting really, really delineated, but that's the difference between accounts payable and accrued expenses. Going down the line here, depreciation, amortization. Depreciation is something that's always added back because you never write a depreciation to anybody. It is a conceptual or theoretical accounting item. Interest, we will assume, although there are some exceptions, especially in a situation where you might be filing for Chapter 11 or bankrupt, but you would assume that interest is always paid. There can be some deferred interest, but it's not common when thinking about this building to a standard definition for operating cash flow, which is what we're trying to do here. So I'm going to assume that that's 0. Income tax expense. If there's a portion of your income tax expense that can be commonly deferred, that is called deferred taxes. We're going to look at, when we talk about depreciation, how depreciation can be utilized to build a deferred tax allocation, deferred taxes. And if you think about, that's it. So we've gone up and down from the top to the bottom of the income statement, and we've laid out all the possibilities of line items that can be adjustable. And that is accounts receivable, accounts payable, accrued expenses. This is, we're simplifying here. Right? Depreciation, deferred taxes. And so if you think about the way we would logically convert this into cash flow from operations, we'd take net income, we'd add back deferred taxes, depreciation, amortization, and our 3 accrued expense, accounts receivable, accounts payable line items that we will later see in the working capital class. This is working capital. And this is why cash from operations is net income plus depreciation plus deferred taxes plus or minus changes in working capital. You're literally looking to the income statement to figure out what adjustments do I need to make. So that is a standard quick overview of the cash flow statement. From a modeling perspective, when looking at Amazon's cash flow statement, the reason why I opened with illustrating the difference between the income statement and the cash flow statement, whereas in the income statement, we looked at this and said, all right, we have to scrutinize this a little bit further. There's no depreciation. We got to move some things around. There's no EBITDA. There's no EBIT. The cash flow statement, we very commonly just lay down exactly as they've had it. Some minor adjustments we'll make, but not as major as the income statement. The cash flow statement, you often want to lay out as they have done because you know that theory, that slogan, cash is king. Very commonly true. You don't want to manipulate. You would have to assume if you've received audited statements that this is literally tying into their cash. There's no manipulation. And I don't mean to say manipulation in a negative standpoint, but in an income statement, timing of recording items, how you're booking receivables, a lot of that's suggestive. It is implied that the cash flow statement is as tangible as you can get. So of all the 3 statements, that cash flow statement, you want to just lay out as they've laid out. And that's what we're going to do. When you look at this cash flow statement, you can see, as it often is the case, I've rarely seen it not the case, that these 3 segments that we've spoken about in the slides are laid out. Cash from operating activities, right, from net income, right, plus your depreciation, deferred taxes, some other line, you'll always see some other line items. We're just going to lay it out as it is. Changes in operating assets and liabilities, that's working capital, right, just as we discussed. Financing activities and investing activities, and then the sum. So when building out the cash flow statement, we're going to literally lay things out line by line. And I want to talk about Amazon's cash flow statement as we do it in a little bit more detail. So when we jump to the cash flow statement, and these line items, we're going to move around a little bit. This has just been based on our template here. Actually, look at this. In thousands, it is not thousands. This is in millions, except share and per share amounts. This should actually link. My apologies for the typo. I'm just going to have equal to the year before here, that those units should flow all the way through all the statements. So I'm just going to make myself a note to fix that. Okay. And so when digging a little bit deeper into the cash flow statement for Amazon, you always start with this cash equivalents, beginning of period. Sometimes you see, sometimes you don't. We don't need it. You want to start with net income. And it's important that you pull the same net income that they have pulled, 3033. And what I like to do, although you can hard code it, this net income, we must have calculated in the income statement. So let's link it in. And the reason why I say link it in is because, as you know, in the income statement, there are different tiers of net income. There's net income before non-occurring events, net income after, before dividends, after dividends. Here's 3033. It looks like they pulled this net income after dividends of 3033. Let's pull that, right? 3033. They had 3033. So I never recommend hard coding the same number twice. If it's linked in, 217, let's link it in. Equals 3033. Okay, that's the number we're going to go by. All the way, I'm going to go all the way through, even when we're making projections. Unchanged. Okay. Depreciation, amortization, historically, is 11478. That's got to match the one that we've pulled, 11,478. And it does. And again, let's link it. I don't want to hard code the same number twice. You're just exposing yourself to a possible error. So depreciation, we're going to link in to the we already hard coded it. It's the same exact number. I know it has to be the same because this is where we initially found our depreciation, because it wasn't in the income statement and we had to pull it out. For a refresher, go back to the past courses on YouTube. And I'm going to color this black because it's a link. Okay. Now we're going to dig into line items that were not identified: stock-based compensation, other operating expense, other expense, deferred taxes, common items that we see on financial reports. Let's just make some space and lay these out. So what I will do is, it looks like they don't have a line for, oh, they do have deferred income taxes. I'm sorry. So I'm going to add, it looks like they don't have a line for intangible assets. So I'm going just to add 1, 2, 3 more rows. Okay, so a quick way to add rows, I'm going to add rows above deferred income taxes. So I'm going to go Shift Spacebar, hold down Shift Spacebar, highlights the row. To increase, Control Shift Plus, 1, 2, 3, 4. Okay, I'm going to keep this line item because it's such a standard. I just want this in my template, but I'm going to add underneath it stock-based compensation. I'm going to add to it other operating expense. Income, net. I'm going to add to it other expense. Oops. Income, net. I'm going to add to that deferred income taxes is already there. Okay, sorry. I added 1 row too many. So I'm going to delete that row. To delete it, again, highlight the row, Shift Spacebar, Alt ED, Alt ED. Good to get as efficient with the hotkeys as you can to be an expert modeler. Stock-based compensation, we're just going to hard code right in 4215, 5418, 6864, and we will have our challenge projecting that. Other operating expense income. If you notice, we had something similar in our income statement. Let's take a look at it. Other operating expense. Okay. 214, 296, 201. Okay. So 202, 274. A little bit different. Why is it different? Again, the income statement records everything. This is just the cash portion of that. So we have to consider it separate, even though it reads the same line item. Don't pull it in because the numbers are a little bit different. That's why it's in the cash flow as different than the income statement. In other words, it's basically saying, here's our operating expense income, 214. Of that, this is 202 is added back is not cash. We need to project the not cash version as separate. 202, 274, 164. Okay. Other expense income net. Again, here we have 346 other expense. They have minus 292. So they're making adjustments for it. So we're just going to kind of lay it out separately. Don't be fooled if it says the same line item. 219, 249. We're going to have fun trying to make projections. Oops, it's minus 249. Okay. Deferred income taxes, minus 29, 441, 796. Okay. So that's the first piece, okay, of our operating activities. Okay. Then we have a very important section that we've identified as changes in operating assets and liabilities, changes in working capital. Now, one thing I talk about in the Walmart book that I recommend you read, and luckily to our benefit, it didn't come out in Amazon, is sometimes companies aren't very good in identifying this section explicitly. Very important for us, we'll see, because we're going to build our own operating working capital statement, that we have these line items completely identified. And I'll talk about it a little bit when I put together the Amazon book, but sometimes you'll see line items in here that are not directly related to operating working capital. So I don't want to get too deep into working capital here yet now, but operating working capital is supposed to be current assets and liabilities that are related to the income statement. Anything non-current, meaning that won't come due within 30, 60, or 90 days, that are non-current, is, from an analyst's perspective, not operating working capital. If it's longer than 90 days, it's no longer operating. It is long-term. So you might see line items like changes in other non-current liabilities. That's not operating working capital for us. You might see other funny line items we'll see in Walmart that aren't related to assets and receivables, but they're in this section. And so it's an important skill to understand, to look at the section and say, well, which of these line items are really related to operating working capital? Now, with Amazon, they specifically say changes in operating assets and liabilities. Good, saves us the need. This is operating working capital. In some other companies, they have changes in operating and other assets and liabilities. And then you got to say, all right, well, which of those line items are truly operating working capital, which is receivables, payables, accrued expenses. And if you see line items that you know are not related, and you can just tell by the names, then you just pull them out above. That's the one of the few adjustments you make in the cash flow statement. You're not taking numbers out or changing numbers. You're just putting them above this little section here. That's all, because it's very important that we have this section identified as ours. But you can see right now, inventory is always operating working capital. Accounts receivable, operating working capital. Accounts payable, accrued expenses. These are standard. Unearned revenue is also operating working capital. So we're going to lay these down 1, 2, 3, 4, 5 line items exactly how they have it. So here's changes in inventory. So if you want to swap it so it's really like them, you can do it. So what I do is, so to swap line items, I'm going to highlight this row, shift spacebar. I'm going to cut, Control X. I'm going to go up to the accounts receivable line, highlight that row, and I'm going to paste. I'm going to do Control Shift plus, meaning insert. So let me do that again, because sometimes I do things so quickly I'm not thinking about what I'm doing, and then when I try to think about it and explain it, I got tripped up. So again, shift spacebar, changes in inventory, Control X, go up to the accounts receivable line item, shift spacebar. I'm going to insert the row, Control Shift plus, which basically swaps the two. Good trick. Okay. Changes in inventory. Okay. Changes in inventory. Whoops. Accounts receivable. Okay, accounts payable. Let's put accounts payable there. So here we go. Once again, I'm going to do a swap. Control X. Going to go up to my right underneath accounts receivable. Shift spacebar. Control Shift plus. There it is. Accounts payable. What's next? Accrued expenses. Okay, so accrued expenses. This says prepaid expenses. Let's just call this accrued expenses. Oops, accrued expenses. And then unearned revenue. Okay, so I'm just going to call this other current assets. I'm going to call this unearned revenue. Changes in unearned revenue. Okay, I'm going to delete these two line items. Okay, so shift spacebar while holding down shift, tap down, Alt ED. Okay, pulled it out. Okay, now Notice I do changes in, changes in, changes in, changes in. They didn't do changes in, changes in. I like changes in. To me, that's very common, standard changes in. Up to you how you want to word it. Okay, let's lay out these numbers explicitly. Inventory minus 3583. Okay. Accounts receivable minus 4780. I'm just going to do 2017, leave you to the rest. Accounts payable 7100. Accrued expenses 283. Unearned 738. Okay. And I'm going to, they don't have it. A lot of companies do, like companies don't. I'm going to, it's going to be very important for when we do our working capital schedule. I'm going to create a total of just the working capital items. Quick way to total items in a series, alt equals. Our net change in working capital is minus 242. And then I'm going to create our total cash from operating activities, which is going to be equal to 242 plus all of these individual line items and make sure it matches. Oops. Oh, what happened to me? What happened? I forgot a plus. Plus. Oh, I'm going crazy here. How'd that happen? Plus. I could have also alt equals everything except for the total. But anyway, okay, 18,365. Does this match? Yes. So I've hard coded everything correctly. Okay. We got a little bit of time. Let's just go through it. Minus 1314. Okay. 4615. 3263. 472. 1151. Okay. And then for 2019, minus 3278. Okay. 7681. 8193. Minus 1383. 1711. Okay, so let's make sure that matches. I'm going to copy these totals all the way to the right. And I should have 3723 and 38514. Okay, so good. I made a mistake. What happened here? Okay, this number. 441796. There you go. There's your 38514. Okay. So what's going to happen is we're going to have to find a way to project these line items. These are going to be tricky to project because there's no real basis for them. Deferred income taxes is going to come. I'm going to highlight this yellow to illustrate this is going to come from our depreciation schedule. And our working capital is going to come from our working capital schedule. So we're going to slowly link everything together. And next week, what we're going to do is we're going to lay out cash from investing, cash from financing, do our best to project. Then we're going to build the depreciation schedule, talk about depreciation. That will link our depreciation in to the income statement and flow into here. We will then build working capital. That's going to link ourselves into here. And then we're going to have most of the cash flow done. Then we need to build our balance sheet and our debt schedule. And then we have a fully built model. Okay. Somebody sent me the Excel. Yeah, so right, you can always get the report in Excel and then just cut and paste the numbers. But I want to walk through them one by one with you. But so thank you. I appreciate that. All right. So guys, next week, we're going to continue talking about the cash flow statement. And if you have any questions, send me an email. But thank you for your time.